than clear. I want to say a very beautiful good evening to everyone. Please use the chat box. If you can hear me, indicate hi there. Okay, Adeni, good evening. Rafi, good evening. Yeah, okay, so as you know, we have to just go straight to business. We will hope that along the line, others will join us. We have a very interesting section today. We will be having a very interesting section today. I will just hope you stand by and get the best of what we have to offer to you today. All right, so today we'll be having a topic under financial reporting. We call it accounting cycle. Today's class will be more practical than the last one, when we have a basic introduction to financial reporting. So in today's class, we'll be looking at the following. What do we mean by accounting cycle? What are the relevant supporting documents to complement our various accounting processes? We will do what we call analyzing transactions and recording in the system. Types of adjusting entries, or what are adjusting entries first. Types of adjusting entries, we look at what a trial balance is, what we call extended trial balance. How do you make mappings on the extended trial balance for the purpose of preparing financial statements? Then preparing ledgers and general ledger, converting a general ledger to trial balance, then practical illustrations. So I want to believe everyone is set for this, but putting the right thing in the right perspective. How many of the current participants have prior audit experience? If you are working in an audit firm, what we want to do today will not be strange to you. Of course, it will complement what you have already known. But if you work in an audit firm, I need you to indicate on the chat box. Indicate hi if you work in an audit firm. If you have anyone who works in an audit firm, can you indicate hi on the chat box? Anyone? Does it mean all the participants we have? Okay, Afiz works in another firm, Damilola works in another firm. Okay, awesome, awesome. So you will have to do us a favor to help those who does not have prior audit working experience to understand this better, right? Okay, so what do we call an an accounting cycle? By definition, accounting cycle refers to the series of processes involved in preparation of our financial statements. So all the sequence or series of things that is done before we eventually come out or come up with what we call financial statements is referred to as accounting cycle. Same concepts can be borrowed in the production process. So we could say production cycle. That would then mean everything that is being done before we, or in the course of which transforming the raw materials into the finished goods. So I believe that is clear. The main purpose of accounting circle is the preparation of financial statements following a standard procedure, right? So it is expected that every organization will have what we call their own standard operation procedures before, that is expected to be undergone before we can come up with what we call a financial statement. So part of those accounting circle is what we want to review today. And for simplicity, I have identified the following processes that are to be undergone before we come up with, or before we can arrive at what we call, or what we can call financial statements. Of course, transaction must have taken place. You must have recorded these transactions in what we call the source documents, right? Example of source documents are receipts, invoice, vouchers, check stub, bank statements, and all of that. Every information or documents that bear financial related or transaction related information are regarded as source documents. So for you to be able to prepare what we call a financial statement from this, you must have done something similar to the following process. Process one, you should have analyzed or systematically segregate all the source documents such that you can have similar ones grouped together, right? In my own perspective, I call that analysis of business transactions, right? We have put together, we will have put up a procedure such that we have maybe receipts that confirms payment of various transactions or sales that must have been made. We will put them together in a particular file or arrange them separately. We will put together all the invoices that must have been sent to the clients before payment confirmation is obtained. We'll put them together. We'll put together everything that relates to purchases, as well as confirmation of various transactions that must be done or that must have been done in respect of various elements of an account, right? So for an organization that does not have a structured accounting system, meaning that they don't have or they are not using what we call an accounting software, if you want to render an accounting service to them, we're going to look at it in two different perspectives. One, the first perspective is where you decide to just analyze the financial records they have given to you and make journal entries out of them, right? So in my wordings, I put the next stage to be journalizing transactions, right? That means you are raising, you are identifying each pairs of transactions, and you are identifying which account is to be debited, which account is to be credited. We strictly adhere to our double entry principle in doing this. Then we'll have what we call post to ledger account, post to ledger or account. The word ledger or account, they're actually synonymous, right? From what you have journalized, you post to various ledgers, right? But what we'll be using today, we will test run instances whereby we post from journals to ledger. We'll also test run instances whereby we post from journals to extended trial balance directly. Then you prepare, if you are going by maintaining ledgers, then you have to extract what we call a trial balance. What is a trial balance? A trial balance is not an account per se for the benefit of those who don't have accounting background, but it is a statement that bears balances of various ledgers. And the purpose for doing this is just to test whether entries that have been made in the various ledgers are correct. If they are not, it's likely that the trial balance may not balance, because there are some errors that you could have made that will not affect trial balance, and there are some that would or could have affected the trial balance. So next thing after that is conduct what we call adjusting entries. We'll be talking about what an adjusting entry is or what adjusting entries are. Oftentimes, you want to differ certain incomes in line with the substantive standards. You know that the relevant standard that relates to income recognition is IFRS 15. So if all the performance obligations has not been fulfilled, and you want to, in adherence to this standard, you want to differ portion of them, of those earlier recognized income, you definitely will have to raise an adjusting entries. So adjusting entries are made in respect of deferrals, are made in respect of accruals. Accruals in this context means that you want to recognize certain expenses that have been incurred, but on whose payment has not been made. And then you could also make adjusting entries in respect of prepayments, expenses that have been paid for a longer period, longer than the financial reporting period, and you want to remove or suspend portion of that expenses that doesn't relate to that accounting period. Then you want to make some estimates. You agree with me that when we have fixed assets and that asset is being put into use, definitely we have to subject it to depreciation in line with IAS 16, not IFRS, IAS 16, right? And for us to be able to do that in this approach, you have to raise adjusting entries. Then from the adjusting entries you've raised, you then have what we call adjusted trial balance, right? If you are using this process for an audit purpose, the nomenclature that will be given to it may be slightly different, but it is all in the same concept. Then you have what we call at the end of the day, from your adjusted trial balance, you can then make up your financial statements. I remember in our last class, we made mention of IAS 1, right? That talks about presentations or preparation of financial statements. According to IAS 1, can somebody bring us to speed? What are the various components of the financial statement according to IAS 1? When you say you have a financial statement, because we just made mention that we will prepare from the adjusting entries, you prepare financial statement. What are those things that makes up the financial statement? Adekanye, you can go ahead. You're raising your hands.
Yes, the components of the financial statement include the statement of profit or loss, the statement
sorry that I had to cut you. According to IAS 1, the standard gave the order of the arrangement. So take it in that order.
Okay, the statement of financial position.
Very correct.
The statement of profit or loss.
Absolutely correct.
Oh.
Correct, go ahead.
The statement of cash flow.
No, before the statement of cash flow, you have something?
The statement of changes in equity.
Okay.
Then the statement of cash flow.
Okay.
Then the disclosure for items
Before then, there is another one. It's called statement of accounting policies.
Okay, sir.
Yeah. Then after that, you then have notes to the accounts.
Okay, sir.
So when you are doing first-time adoption of IFRS, it then gives you those restatements you have to make, comparative statements you have to make on your SOFP.
Yes, sir.
Right? But it's a good try. Thank you very much. And for others who have also made contribution on the chatbot, it's well appreciated. Thank you. So that being said, that will be the component of the financial statement in line with IAS 1. So when we say that we are preparing or we are to prepare financial statement from the adjusted trial balance, it means we are to put together all of these statements that is applicable to the client's business. That being said, let's go to the next slide. Any question on that first? Any question on what I've said or what I've explained thus far? Please, if there is any terminology I've used in the course of this presentation that you don't understand, call me to question immediately. Do you have anything that you want me to throw more light on based on what I've explained thus far before we go on? We'll be doing a little bit. Yeah, go ahead. Have the floor.
Yes, sir. Yes, sir. So I just want to seek a clarification, because why you are speaking, you first mentioned FRS 16, but now immediately changed that is IAS 16. But because for some time I've been saying that sometimes some we use IAS 16, some we say FRS 16. Those words, are they similar to each other, or there's a different dichotomy between the IAS and IFRS according to the accounting standard?
Okay, so that would take us to part of what we explained last week. Remember, we said that under the regulatory framework for accounting, there is the legal aspect and there is the accounting standards. And in Nigeria, accounting standard we used before 2011 was called Statement of Accounting Standard, SAS. Even those periods when we were using SAS, globally, there has been in use what we call the IAS. IAS means International Accounting Standards. So in 2011 to 2012, Nigeria actually adopted the use of IFRS, right? So whenever we say IFRS, IFRS means International Financial Reporting Standards. It is used in substitute, or it is a synonym of IAS. But when you now want to refer to each of the IAS or IFRS, those words must be used with a deliberate intention. Say, for example, I said IAS can be used in substitute for IFRS when you are referring to the standard. But if you want to refer to each and every component of the standard, the word IAS cannot be used in substitute for the word IFRS, because there are different sections that each of the IFRS or IAS addresses. Say, for example, you remember I made mention of IAS 1. IAS 1, as far as it's concerned, it's just unique on its own. It is the part of the IAS that addresses how we should prepare or what should be the components of our financial statements. And the standard calls it presentation of financial statements, right? IAS 2 stands for something different too. That one talks about inventories, right? IAS 3 has been repealed, IAS 4 has been repealed, IAS 5 has been repealed. Repealed means that it has actually been deleted, not necessarily repealed, right? IAS 6 has been repealed or deleted. Then IAS 7 talks about statement of cash flows, right? So that period when I mentioned IAS 16, the standard that relates to accounting for non-current assets alongside with its depreciation is IAS 16. IFRS 16 talks about something different entirely. That is on lease. Do you understand? So when we are using each of these terms, right, we must use it with intent. We need to know what each of the IAS stands for and what each of the IFRS stand for. But when you want to refer to the accounting standard, IAS or IFRS can then be used in substitute. I hope that is clear.
Yes, sir. Thank you, sir.
Okay. So altogether, we have 41 IAS, and as at today, we have 17 IFRS. So as accountants in practice, we are expected to know each and every of those IFRS or IAS that relates to various accounting issues in various companies or clients' affairs. So that being said, is there any other question that anyone expects or is seeking clarification on? If there is none, just indicate go on the chat box. If there is no need for any other clarification, please type go on the chat box. All right, thank you. Oh, somebody said you have a question. Who is iPhone 11? Please tell us your name and ask your question.
Good evening, this is Grace.
Grace what?
Grace Carlo. Sorry, let me change the name.
Oh, okay, okay. The Grace from Abuja.
Yes, sir.
Okay.
Please
find out. You have the floor.
I heard there's a new standard, IAS for AMS, right? Is it?
No, IFRS for SMEs.
For SMEs. Is there any difference between the actual, the normal IAS and that of the SMEs?
Okay, let me put clarity to that. Thank you for asking that very question. It's a very important question. Our IAS and IFRS is the same, right? Mm-hmm. But you will bear me witness that the disclosure requirements as expected by these IAS and IFRS sometimes is so much that it is uneconomical for most of the smaller business to adhere to. Say, for example, IFRS 13 talks about fair valuations. And you know that most of the time, if you want to fair value any liable assets, the procedure requires you most of the time to use an expert opinion in doing that. Let's say, for example, you are auditing the account of a company that is into real estate, and you need to fair value some of their buildings. You will not be able, you might not have sufficient data to be able to do it as an accountant. You probably will need the expert opinion of an estate valuer. Now, if that company is a small company, the cost of hiring an estate valuer may not be affordable to them. Are you with me? So because of this, the drafter of this standard now says that, okay, it is still the same IAS and IFRS, but let's do another one that the disclosure requirements for SMEs will not be as detailed as that of the large or quoted companies. You understand? So it is still the same. If you check the IFRS for SME, please, who is making this distraction? Kyla. So the same, if you check through the IAS one in regular standard and the one for IFRS for SME is the same, but it's just that the disclosure requirement is minimal compared to the ones that we have for large quoted companies. So this is where I will urge you accountants and auditors in practice to pay attention. If you are auditing the accounts of a company that is an SME, and you say you have used, in the audit opinion, if you say you have used IFRS, then it means you have not done the right thing. Because most definitely, there will be a number of exceptions that you might not have carried out all the provisions of the standard to the latter. Meanwhile, you said you have used IFRS. So I think the most important thing for you to have done or to disclose is to say the standard you have used is not the regular IFRS, even though they are the same, but you specify you have to be very specific that what you have used is IFRS for SMEs. Grace, I hope that is clear.
Yes, sir.
Okay.
Yes, sir. I'm okay. I'm okay,
you
but
need to-
please, how do we get this? Because I've been trying to, I heard of it, I think in our last district meeting, somebody came to deliver a training on it. So I tried to make contact with him to see if I can have maybe a way I can access this material, but I didn't follow up, Sha. I didn't follow up. So I don't know if you have any information on how I can get this
okay.
material.
I have the soft copy, but if you want to get an hard copy that is very updated, FRCN, it's available for sales in FRCN office.
Okay, Financial Reporting Council.
Yeah, they sell all of those standards.
Okay,
Yeah.
thank you.
All right. But I can also share the soft copy I have with as part of the instructional materials we share with this alongside with this. Or if you
Okay,
then
sir.
need,
Yes, please. I will appreciate it, please. Thank you.
Grace, you like it. All right, no problem. I promise I will share it.
Thank you.
All right, so please take this feedback. The regular IFRS is the same thing with the IFRS for SME, but the only difference between them is that the disclosure requirements or all the processes that the regular IFRS say you should follow, when you check the IFRS for SME, most of them are watered down. And it is just because if you have told the SME detailed procedures, it will not be economical for them. So bear it in mind that the regular IFRS is expected to be used by large companies or quoted companies, while every other SMEs are expected to use the smaller ones. 1 minute.
A yadda muka yi da kai za ka fita mana sauran sai ka ba shi. Magana ya tabbata. Na ga ai kamar an raba mun je gun sallah ma gaisa. Na ga an raba mu shi na ai mu
Hello, who is distracting us here? Mukaila, I will delete you from this training section if I hear noise from your side again. Why are you doing this? All right, so let's quickly go on. So I said the first part of this slide actually introduced us to Accounting Circle, and I've made mention of all those procedures that we should have in context gone through before we can come up with the accounts. And for us to be able to do all of this, analyzing the business transaction before we journalize, you can't do that if you don't have what we call the supporting document. So I put this as support documents for financial transactions are called source documents. It bear records of financial information of transactions that have been executed or consummated. The nature of the financial transaction will influence the underlying source documents required to be maintained. Some of the common ones are the receipts, the invoice, the vouchers, the bill, the check stubs, the bank statements, extracts, and the likes. So from time to time, you will have to know which of the source document that is relevant for your client's affairs per the transaction at hand. But note that all of these documents are called, it's either you call it supporting documents or you call it source documents. So we did mention that the very first one of all those processes is analyzing those transactions. So recall that the process of posting financial transaction could be fully automated, partly automated, or completely manual. So when you want to prepare the financial statement for your clients or your companies or your employer, you will have to decipher all of these peculiarities that's applicable to you. I don't believe there is any company now that still use the complete manual process, but most people would have been using what we call the partly automated. That is, you use a spreadsheet such as Excel that you then use in preparing the financial statements, or you use what we call any of the accounting software, QuickBook, Sage, Tally 9, mention them, Xero and the likes. So that is what I mean by the fully automated. Now, if you are using an automated process, the accounting cycle will be determined by what has been pre-programmed in the software. So it may not follow entirely what we are looking at today, right? So we are making an assumption that for the purpose of this class, we are examining a partly automated process. So full automation refers to the use of robust software, but the partly automated refers to the use of Excel spreadsheets. You have a look at it as we go on today. It is therefore important to understand the peculiarity at hand before deploying the most suitable approach. So what I meant by that is, if you have the resources and you know how to use the fully automated and it's available, of course you can go ahead to using it. So, but most of the fully automated process, their procedures or cycles are the same. You will just have to raise your journals, identify the account to be debited and to be credited, while the system will just complete the whole or the subsequent processes up to you being able to view your reports, right? So I encourage that it's not a bad idea if you still pick up 1 or 2 trainings on any of the softwares. It will help or increase your chance of being more employable if you are still in that space, or it will give you a better room for you to understand the processes of your clients if you are in consulting. But please note that we assume a partly automated approach for the purpose of this mentorship. We shall be assuming transactions for various scenarios as outlined below. So we will look at where a client provides an handwritten notes of its day-to-day financial dealings. That is, we still have some of these SMEs that they will give you, they'll give you what we call an hard cover, where they have written what they have earned as income and what they have expended as expenses, and whether capital expenses or recurrent expenses, right? You could have such clients. How do you put or use the partly automated process in coming up with their accounts? We'll be looking at that today. Then we could also look at where a client only provides a bank statement. There are some clients that they would not even record anything in any book, but small employables shall be discussed in Please indicate if you can hear me. My network was earlier interrupted.
Okay, we can hear you now.
Okay, thank you. And I'm sure you can see my screen too.
Yes, we can.
Okay, good. So we just want to look at all the process up till when we will put generate trial balance. Adeni, you are disturbing us. So, but before we start, we don't want to assume that everybody already had the entry behavior on this. So we'll be looking at what is a trial balance and what is what we call ETB. ETB means extended trial balance. So trial balance is not an account per se. Rather, it is a financial statement showing the balances extracted from various ledgers of a particular company as at a defined time. So it has both the debit column and a credit column. It's not the debit side or the credit side. It's not having a debit side and a credit side. Rather, it has a debit column and a credit column. Permit me, for the benefit of those who have not seen it before, to quickly show what it looks like. So indicate if you can see my screen. I'm showing an Excel spreadsheet. Please indicate if you can see my screen. I'm showing an Excel spreadsheet. Okay, good. So this is what a trial balance will look at like. In some of these automated ones, you will see the account codes, you will see the elements of account, you will see the ledgers, you will see the debit column and the credit column. So generally, when you want to extract a trial balance and you have not been told whether each of the ledgers has a debit or credit side, we use a rule that we call debit anything that is an asset and expenses, while we credit anything that is income, liabilities, capital or equity, and provisions. Right? So take note of this rule. It is very, very important in your work as an accountant. Very key. But this is how a trial balance look like. And I did make mention of extended trial balance before. Let me just also show you how an extended trial balance looks like. So as the name implies, extended is just like the regular trial balance, but it has other extensions, right? So you still have account codes, the elements of the accounts, the ledgers, that is the account heads. Then you have the trial balance, that's something similar to what I showed you earlier, having the debit column and the credit column. We have what we call adjusting entries column, that is also having debit and a credit column. Then we have what we call adjusted trial balance, that is also having the debit and the credit column. Then we have other extensions like the income statements, that is also having the debit side and the credit side, not the credit side in the context of double entry principle. We're just saying that those things that will appear on one side of the alignment or presentations of income statement are the one that will appear on the income side. Then we have the balance sheets that has the debit column and the credit column. So this is what we call an extended trial balance, extended trial balance. Please, we will still do a practical scenario around this, but let's complete the slides first. So I'm back to the slide. Confirm if you can see my screen. Back to the PowerPoint presentation. Confirm, just say hi if you can see my screen. Okay, awesome. So we can go on. So tribalance, I've told you what a tribalance is, and I've just shown you how it looks like. Why do we need tribalance? It just helps us to confirm arithmetic accuracies or correctness of postings that we must have done in the ledgers before now, right? That is the main purpose for preparing trial balance. So I put it here as the objective of trial balance are to test correctness of postings or entries made in the ledgers, to test the correctness of balances made in the ledgers, so it indicates that there may be errors in the posting. So when the two sides are not equal, we could say there are errors in the cost of extracting this trial balance. So we'll see that in the practical sections. It helps to provide summary of balances, which are then used in the preparation of various statements specified as components of the financial statement according to IAS 1, right? I believe that is very understood. The next one is preparation of trial balance. How do we eventually prepare trial balance? I've said it earlier on that trial balance is not an account per se, rather is a list or schedule showing ledger balances, including cash and bank and other elements of the account. It is prepared on a particular date or as at a particular date. So it would be wrong for you to say trial balance for the year ended. No, rather it is trial balance as at a particular date. So most of the time we see trial balance being extracted as at the end of the year, or if you are preparing your account on monthly basis, you can say as at the month ended. If you are preparing it on weekly basis, you can say as at the week ended, or daily basis as at the day ended, whichever one that is applicable to you. So this is also something to complement what I earlier showed you. Your assets must always have a debit entry. Liabilities must always have a credit entry. Equity must always have a credit entry. Equity is another word for capital. Drawings must always have a debit entry because it's an expenses. Revenues must always have a credit entries, and expenses must always have a debit entry. So the steps to preparing or extracting trial balance, which is our focus today, is at first ascertain a balance account wise, the balances of all the ledgers that are in question. We will be having a practical scenario now. Then second one is that write the names of the ledger accounts in the various ledger columns. Then write against the name of the ledger account the balance of the amount. You will see that. Then add up the debit side and the credit side and ensure that both are equal. Let's have a practical scenario around that before we consider ETB and the likes. I hope we are all together. Please indicate if you can see my Excel screen. All right, so let's have a look around some of these scenarios we want to put to play. This is how a trial balance looks like. I've said that before. This is how ledgers will look like. I've also indicated that before. And we'll just play around some of these ledgers and we'll make the trial balance out of it, right? Please, I hope we are all ready now. Hello, please indicate ready if you are actually ready. We want to make some practical illustrations now.
Ready.
Indicate ready on the chat box if you're actually ready. All right. So we want to assume some scenarios. Look at it. I did make mention of journal. So I'll be using journal entries first of all. You will see as I do this. So I'm assuming that the name of the company is ABC PLC. I'm also assuming that what we are doing here is the journal entries. Then normally, a journal entry will always have the debit side and the credit side. So this is the serial number. This is the narratives. All right. So the first JV, journal entries we are having, let's assume that a company just commenced business with ordinary share capital of 2 million. And this 2 million has been deposited by each of the shareholders in the bank accounts. So we are assuming that they are using Bank One, right? Bank One is the name of the bank, and they have deposited 2 million naira. So let me take names of people on this platform as part of the shareholders. So we are taking Abdullahi and Abiodun as the two shareholders. They have both contributed 1 million naira in the bank. So I need somebody to unmute in ABC PLC, and they have both contributed 1 million naira as their shareholding. They've deposited it in a bank known as Bank One. How do we make these accounting entries? Anybody, please?
Hello, good evening, sir.
All right, good evening.
Okay. The accounting entries to be made. We credit the capital and debit the Bank One with 2 million.
Okay, but this, you know, this time we are having two shareholders.
Okay.
Please, if you are not talking, mute your mic. If you are not talking, mute your mic. Go ahead.
Okay. What we do is we'll write capital, then we'll differentiate the two shareholders by.
Okay. So we have Bank One. Bank One, we have 2 million. Do we all agree?
July 1 million.
Then we now say ordinary share. Abdul has 1 million. And who is the second person? Abiodun, right?
Abiodun, yes.
Has 1 million.
So that balances it up.
1 million. Remember, you don't sum up
the journal.
So if you want to sum it up, you can, but sometimes it's not necessary. But you can also just do this for control purpose, right? Then a journal entry will always have narratives, being ordinary share contributions from or by the shareholders. Right?
So, are we missing the date?
I believe everybody can see this.
Yes.
Yes,
Okay,
I can
somebody
see
made
it.
mention about the date. Let's say as at 1st of January, 2021, right? Now, one thing that I want us to see next is how do we make ledger out of this? So I want to change this to, this is the ledger now, ordinary share. Ordinary share, but we have it in for Abdullahi. Who is that? Sorry, 1 minute. Let me just quickly repack. My neighbor wants to move out. 1 minute, please. Sorry, I'm back. I'm so sorry. Are we all there? Hello?
Hi. Yes, sir. We are here.
Okay, so this is how we show, the ledger for Abdul, the ordinary share of Abdul. I'm sure everybody can see my screen. So under the elements of an account, this is equity, right? The name of the company is still ABC PLC. The ledger now is now ordinary share for who? Abdul. Right? So we did confirm that the transaction occurred on 1st of January 2021. The account head here, please, I hope everybody is listening. This is the account head that the corresponding transaction will be traced to. That is Bank One. The transaction description will be deposits for ordinary share. So if there have been any documents that have been filled as a source document, then you put the reference number here. Now, remember that in the ordinary share account of Abdul, we are crediting it. So we credited 1 million. All right. So if you want to do same thing for who is the second shareholder? Abiodun. Yeah. So we just quickly repeat that. Equity. But this time we are having ordinary share for Abiodun. The opening balance is nil. That transaction occurred on 1st of January 2021. This is traceable to Bank One, right? Deposits for shares. And here we'll be having 1 million. All right. I believe everybody can see that. Then the corresponding entry is in respect of the Bank One itself. So let's say this is Bank One. Bank One is a current assets, or simply call it just assets. So we come in here, the name of the ledger is Bank One. So this will give those who want to use this template I already shared, how to personalize it. So who can tell me what the account head in this one will be? In our Bank One, what will be the
Ordinary shares capital.
Awesome, awesome. Ordinary share, but in respect of each of them,
Yes.
Abdul, right?
Yes, sir.
For linking purpose, I can just link that. Then this time the debit entry is coming to the entry is coming to the debit side. On that same date, I will still have ordinary share, but this time Abdul. And I can link the narrative to, right? Then link the amount. Abdul. The first one, oh, sorry. The second one should be Abiodun, not Abdul. Abiodun. I'm linking this to Abiodun, and I'm linking the amount to Abiodun too. So you can see that assuming assuming that this is the only entry we have in our in the year, our trial balance, I will come in here under the assets, the current assets. Where do we have, where we have
Cash and bank balance.
Cash balance.
Are we together?
Yes, sir.
Yeah, what is the bank balance in, what is the ledger balance in bank one?
2 million. 2 million naira.
2 million naira. Then in the shareholder account, I'm having for share capital, I'm having share capital for Abdul. Will it be a debit balance or a credit balance?
Credit balance, sir.
Credit balance.
Okay. So I will link this to Abdul's ledger, the ledger balance. Okay, I've not linked the quickly do. The opening balance linked to this. The credit entry is linked to all of this. And the debit entry is linked to all of this. So the closing balance should be opening balance plus credit minus debit. So same thing for Abiodun's ledger. So when I'm linking this, you can see Abiodun is showing on the ledger balance, on the trial balance 1 million. Abdul is showing 1 million and Abiodun is showing 1 million. Assuming this is all the entries you have in the trial balance, let's see what the total will be. The total he is having this noise. Child. So I'm sure you can see that the total balance is showing 2 million on both sides. So this is how you raise journals, and this is how you also transfer the journal to the ledger, right? So you can see my journal balance, journal entry in Abdul ledger is linked to the journal. The journal for Abdul is 1 million. And if you come to Abiodun 2, I've linked it to the journal entry of 1 million. Then the bank one ledger 2, I've also linked that to each of the various ledgers. So that's number one. Number two, let's also put up, say for example, still in this particular company, journal 2, they have decided to use 500,000 as rent from the amount in the bank. Who can tell me what will be the accounting entry?
The accounting entry will be credit bank and I will debit rent account with 500 naira.
Okay. But if I want to make that disclosure in line with IFRS 16, I won't call it rent. I will call it right of use of assets.
Okay.
I'm sure we all agree.
Okay.
Right of use of assets will be debited with 500,000, and bank one will be credited with 500,000. I will say being rent or bill lease rental for, let's say it is 5 years, for 5 years. For 5 years ending in this 2021, 5 years will be 2025. So we have the total of that too. And that is close. So let's see how we will translate these in our various ledger. This entry has nothing to do with ordinary share of Abdul, and it has nothing to do with ordinary share of Abiodun, but it has something to do with Bank One. So the transaction occurred, let's say here, that the transaction occurred on January 3rd, 2021. I'm just trying to telling you or showing you how we can apply this if you are not using a fully automated software. So on 3rd of January, 2021, you can tell me the account head. What is the account head?
Right of use of assets.
Okay, that's very correct. Right, I'll just call it ROU. Right, then the description would be lease rental for 5 years. Are we to debit this or credit this?
We will credit this bank now, so credit it.
So you will see how I will link that journal, that ledger journal credits. Right? Then because we don't have the ledger already for ROU, I'll just create one. If you are using an automated system, it will automatically, the moment when you are setting up the account, you will have created the account if it is not there by default, right? Those who have been using the accounting software already, they can relate with this very well. That occurred on 3rd of January, 2021. The account head in this respect will be what?
Bank One.
Bank One, awesome. Who is talking, please?
Azuka Monday.
Azuka, thank you for your contribution. So we said, what is the narrative now? Being lease rental for 5 years. Are we debiting in this one or crediting?
We are debiting.
We are debiting because it's much more like a capital expense, right? But you will see that we have to link it to our journal. The reason for the linking is that if for any reason we have to make a correction from the journal, right, it will automatically be reflected on the ledger by default. I hope we are all together.
No, sir.
Okay. So look at what I will do now. I want to be able to link the ledger, the trial balance to it. The right of use of assets will normally, is normally an asset because it's for 5 years. So I will assume that I'm having right of use of assets as an asset here, I'm linking it to the ROU ledger. The closing balance is 500. Let's go and check what the balance in the bank will be. You can see that automatically bank balance has adjusted to 1.5, right? If you go down, you will see that the total, the two side is still correct, the 2 million. Are we together? Please, I need you to
Yes,
confirm if you are following or you understand what I'm explaining or not. Any question on what I've done thus far? Okay, so let's pick 2 more transactions and see how this is reflected. Let's assume that the rent for that month alone, out of the 500,000, how much will be 1 month rent out of the 500,000?
100,000.
1 month. If 500 is for 5 years, 1 month will be what?
1 month will be 1 divided by 60 times the amount.
Okay, so take note of that. We are coming to that. I will ask a question around that much more later on. Then, assuming we have inventories. Inventories, the bought inventory of, let's say 1 million. So we'll debit inventory with 1 million. But this inventory was actually bought on credit from, let's pick another person's name. Let's say Grace this time. Grace is the vendor. We call it payable, but the name is Grace. 1 million. We sum this together and we have been purchase of inventory on credit from Grace Ventures on 1st or let's say 5th of January. Right? Can somebody tell us how to make the journal of it? Where will be the 2 journals that we are creating? We have inventory.
We have payable.
And we have the payable. Payable for who now? Grace Ventures. So you will agree with me that this process is not far-fetched from what would have happened if you were using your fully automated software. It's just that the individual ledgers, the software will have made it up on its own. So for the inventory is a current asset, right? We change the ledger name to inventory. Opening balance was nil, but on the 5th of January 2021, what will be the account head now, please? Account head will be what?
Payable Grace. Payable Grace.
Awesome. Awesome. Payable Grace. Description will be being purchase of inventory on credit from Grace Ventures, right? So if we have all the substantive source document reference number can be there, are we to debit this or we are to credit this?
Debit, sir.
So we link it to our journal, will be debited, and the corresponding entry will be in Great Venture. That is a current liability. So the ledger name will be
Grace
payable Grace Ventures. I hope we are together.
Yes, sir.
5/1/2021. What will be the account head now?
Inventory.
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 Also. And we say being goods, being inventory,
but
purchase from Grace Ventures. I hope we are there.
Yes, sir.
Yes, sir.
Yes, sir.
So are we having this as a debit entry or credit entry?
Credit and
Debit.
Who is saying debit? It's not debit, so it's credit. Payable. Payable. Don't forget, please. So we come in here, we link it to the credit side. So you will see that this by default automatically ties. Right? So let's see, let's go and update our trial balance. Normally we should complete everything before we do the trial balance, but I want you to see the flow. Are we together? So the inventory, it's under current assets. So we have the inventory for, it's a debit balance. We link it to the debits, closing balance here. And the payable is a non-current liability. We call it payable Grace Ventures. So we have the balance. So let's go and see what our closing balance will look like. Let's see what our closing balance will look like. You will see that the closing balance, on both sides of the trial balance is still equal, right? Do we agree?
Yes, sir.
Okay, so this is how you make up your ledger balance on day in, day out, right? So if you have not been using, for most of us that are auditors that render accountancy service to our clients, and we are not using an automated software. I understand that what most people do is just to do a bank analysis, and from there they raise journal and they link it to the ETB straight. But my experience has shown that if for any reason, FIRS decide to conduct a tax audit on the client and they request for ledgers, we will then be at their mercy because we won't have anything to show for it. So we can actually deploy this approach to making up ledgers for our clients, even if all they provided us with is just the bank statements. So after doing all this, you can also go further to ensuring that they put into perspective the right supporting documents for all those transactions. So that's where I'm going to hold it while we go back to our regular slide. This is just to actually make us understand that that is how trial balance is being made up. You can see how we move from the journals to the ledgers, from the ledgers to the trial balance. Any question? Please ask your question if you have any.
Sorry, sir.
Okay.
No, I've not been used to this Excel computing.
Oh,
My
really?
question-
Who is talking? Azuka, right?
Yes, sir.
Do you use a regular accounting software? in
Of
your
course, I've
place
been
of work?
trying with using software. I've never tried Excel. I've been using software from right from time.
Oh, okay. Which software have you been using?
QuickBook, both
Oh,
desktop
QuickBook,
and online.
good.
Yeah.
Okay, go ahead with your question.
So my question is that is this how we'll be doing all these things till the end of the period time or something using Excel?
Yes,
Or
because
okay.
yes, because if you are then be used, you can then, if I'm using the one I use in my company, for some clients that are not having fully automated whatever, I program the Excel such that I don't have to move from tri-balance to this to that every time. I will have linked everything. So all I just need to do is put in the double entry, then link the, raise the journal rather, link the journal to the ledgers, and everything falls to place. I even linked it with the ETB. I linked it with the notes to the account, link it with the account proper. So per time, everything will just flows in. The only thing I will take my time to do is to raising the journals and link it to the ledgers.
Jesus.
But that is the advantage of using a fully automated software. You know, in fully automated software, the only thing you do is just to raise your journal. Do you agree?
Yes, sir. All right, check.
While back end, or the back end, the software then completes all the other process.
Yeah,
But
the reason I'm asking this question is because, okay, for example, now you get into, you are being employed as an accountant now for a business that I've been running for the past 2 years now, and you request for their bank statement now. And you know their bank statement, they have a lot of transactions that maybe it's over 10,000 transactions. So is this how I'll be raising journal for each lines of item in the bank statement?
Truly, there are shortcuts on how to approach that kind of scenario, right? I will, if you are in that kind of scenario, I will not expect that you take that time. But if you have ample resource persons, maybe the junior teams there, and you really want to do the right thing, you know, the right thing is that Adibin, you've been on ground when those transactions occur on day-to-day basis. You will have updated it on day by day, right?
Yes.
But if you then join after some years and they don't have an automated record and all of that, the truth be told, you have to do everything one by one. It can take you donkey periods, but you have to do it. Because if you model everything up, by the time FRS comes, right, and what you have simply done is bank analysis, then you will be at the mercy of the FRS, because FRS will not agree that the classifications you have given to each of those accounts in your analysis is as honest as possible. Do you understand? So what we advise clients to do is that from the very inception of their business, try as much as possible to update the records as it ought to be. But if you join them in the process, there is nothing you have to do. You have to follow the process and get it sorted out. Otherwise, if you model it up, it can fly, because you'll be able to give the final report to your client, to your employer. But when tax people will come, you will then be at their mercy. Does that answer your question?
Yes, sir. Yes, sir. Thanks, sir.
All right. But this will, you will also agree with me, even if you get to that kind of organization and they are using a fully automated and they've not posted for years, will you not post one by one?
Of course, I post one by one, but it's more faster using software.
Yeah, because it will complete the other ledger parts. I
Exactly.
agree.
Yes, sir.
I agree. I agree. All right, so that is what you need to know about the first aspect of what we are set to do today. The second aspect of what we are set to do today is what we call the extended trial balance. for most of you who have just been a regular accountant, this may be the first time that you are hearing this, but this extended trial balance is very common to auditors, right? Because when they come around to audit, is this one of their working tools? But extended trial balance is just like our regular trial balance too. It only avails us the opportunity to make some adjustments that is necessary on the trial balance that the client has provided, so that from there we can then continue to do our workings. I think I've shown you how an extended trial balance is, right? So an extended trial balance is a standard trial balance with added columns extending to the right, and in which are listed the following categories. So you have adjusting entries. What are those adjusting entries? Adjusting entries are those corrections, restatements, and reclassifications that we need to make on the closing balances of items in the ledgers. And 4 things could warrant adjusting entries. One is accruals, right? When you want to make an accrual for expenses that have not been incurred, and as at the end of the period, you need to recognize those expenses. You need to reflect it in what we call the adjusting entries. Then if you want to make adjustment for prepayment, remember in our previous illustration, there is a noise coming from the background. Who is this? I think Ibidokun. Ibidokun, please adjust your mic, mute your mic. All right, so another thing that could create room for adjusting entries is what we call prepayments. You have paid beyond the reporting period and you want to suspend or defer what you have in the portion of the payment that doesn't relate to what you have, the period you are accounting for. For example, in that our illustration, we paid 500,000 for 5 years. If the account we are preparing is not for 5 years, then we will need to defer or recognize as prepayment the remaining balance that doesn't relate to that period. So you will see how we will adjust for these two. Next one is what we call deferrals. Deferrals. You have clients that have paid you, let's say 2 million or 100 million for certain services. And at the end of the reporting period, in line with IFRS 15, you decide to reappraise your performance obligations and see to what extent have you fulfilled the performance obligation, the 5 revenue recognition models. And you find out that not all performance obligations has been fulfilled. So let's say out of the 100 million that have been paid to you, you have only fulfilled obligation with respect to, let's say, 75 million. So you will need to defer the remaining income. So in doing that, you will have to use adjusting entries. So then other ones are estimates for provisionings, right? If you want to do recognition of provision for depreciation or doubtful debt or any other provisioning in line with IFRS 9 or any relevant standard, you can also use adjusting entries to reflect in that. So let me quickly go back to, but before I do that, after adjusting entries, you have the closing trial balance, then you have the income statement, you have the balance sheet. So let's quickly go back to that ETB and see again how this could be reflected. Assuming all that we had in our trial balance to date is what we have posted. If you want to transfer this to ETB, let's see how this will be done. Are you with me? So you will see that first thing first is to link your closing your trial balance to your ETB. You will see what I will do. We have we have what we call right of use of assets. It has a balance, right of use of assets. What other thing do we have? So you can see that I've been able to bring in my tri-balance figure, and the total it's showing what we call, it's showing 3 million, 3 million. That ties with what I have originally from my tri-balance. So I want to perform those adjusting entries on my ETB. Let's do that together. So who can remind me some of the things that I said who warrants for adjusting entries? Who can remind me?
The right of use assets, rents, monthly allocation of rent.
Accruals, prepayment, deferred income. Accruals, prepayment, deferred income.
Okay, accruals. So let's see how we do adjusting entries for Accrual. For Accrual. You remember the explanation I gave to you that in Accrual, you have incurred some expenses, but you have not paid. So you need to recognize the entry, right? So all I need to do is to come to my journal and say journal 4. Maybe I'd use the service of auditors, 1 million naira. So I say Grace, Kalu, and Co. is the auditor. So first of all, I will say audit fees with 1 million, that is the expenses itself. I will say, what do we call it now? Accrued, that will be payable, right? Payable, accrued audit fees. That is 1 million. You total this. And the narratives will be being recognition of audit expenses for the period ended, let's say January 2021. So, as at the period we are raising this journal, the tri-balance has already been completed. So we can't go back to the tri-balance and say we want to reopen it, because if you have closed it, you have closed it. So we can then make the adjustments in ETB. But for you as in-house accountants, if you raise the journal on your software, the software will automatically update it. But if it is the auditor that spots that this error has not been made, this omission has been made, how to correcting it is raise the journal, then link your journal to your ETB. So let's come here and look for whether we have the two entries. The two ledger are audit expenses and payable audit fee. So let's look for audit expenses. Which one do we have there? On the liability side, we are having, let's call this the payable accrued audit fee, right? So if I'm raising that journal, I've raised the journal already. You will agree with me that accrued audit fee is to be credited. So I will come in here and say link the role for accrued audit fee. I will link it to the journal. Then the corresponding entry is audit expenses. Let me see, we scroll down whether we have it. Okay, we have it. So I will then debit it. So this is how to adjust for adjusting entries, right? So let's take one more on that. Let's assume we are doing journal 4. Remember, one of the things that calls for what do we call it now? Adjusting entries, accruals, then prepayments, right? Let's do something on the prepayment. We have a rent before, right of use of assets, that it has been prepaid. I mean, 500,000 have been paid. Let's assume 400 of these. Assuming 400 of these represent prepayment, the adjusting entries will then be between what and what? Oh, let's take it this way. We had earlier recognized right of use of asset as an asset before. We now want to write what is the portion of this 500,000 that will be recognized as expenses for the year. So if 100,000 represent the expenses for the year, that is the estimates. We have done the estimate. What do we debit? What do we credit?
So we will debit rent for the year, and then we credit the rest of asset with the amount apportioned.
You know, we should not call it rent for the year. IFRS 16 says we should call it amortization, or I mean depreciation of right of use of assets.
Okay, noted, sir.
Do you remember? Please take note of it. So we call it depreciation of ROU, and the corresponding entry we go to right of use of assets. So we are debiting depreciation of ROU with 100,000 because that is what has been used up in that year. And we are crediting right to ROU with 100,000. If we do the summation of this, that gives you the total. We say being recognition of depreciation of ROU, right? And how do we link this to the ETB? We come in here and we look at which one is the ROU. We've been able to spot it. It is to be credited. We say equals to, go and link it with the journal, right? Then we recognize depreciation of ROU. Do we have depreciation of ROU before? If you don't have it, we'll create it there. Okay, we don't have it, so let's quickly create it. Let's assume we can create it here. Depreciation of ROU. So that will be debited. That will be debited. And as you can see, if you come back to check your control, both sides of each columns of the balance of the tribalance are still equal. The one under tribalance is equal. The one other adjusting entries is equal, right? So this is how you reflect those adjusting entries. Then the next one is the closing or the adjusted tribalance. Please look at the technique here for the benefit of those who are not used to this before. So you will say equals to debit plus debits minus credits minus credits. We give you the balance you have here. Same thing for the credit side. Credits plus credits minus debits minus debits. We give you the balance, then you scroll down, copy and paste, scroll down. So it will have updated that, so we can then remove the negative figures. We can remove the negative figures. And remove the negative figures. And let's see whether our adjusted trial balance will be equal. So in our adjusted trial balance, the total for both sides is 4 million, 4 million. I believe you can all see. Please, before I go on, ask me a question. Is there anything you don't understand or what you want me to clarify? Because we are making it, we are building on what we have done thus far. Is there any question, please?
Thank you. Go ahead, sir.
Okay, I hope we are still all there, or some people have gone to watch football.
Hello, sir. Hello, sir. Hello. Can you hear me,
I'm
sir?
with you. I can hear you.
Okay. As regard to adjusting events, adjusting entry.
It's not adjusting events, so adjusting entries.
Adjusting entry, yeah. Adjusting entries. So
adjusting events is IS 10. I hope you know.
Yes, sir. Thank you, sir.
Okay.
So as regard to this, it seems it's only the items that have not been adjusted for that will appear over here, right? Am I right, sir?
Exactly. Not everything, but the only one that requires adjustment.
Adjustment. Okay. Okay.
So this
also,
is go ahead.
Okay. On the adjusted trial balance, the format this one say debit plus debit,
yes,
minus credit plus credit.
No, what I use for me to get the debit balance in the adjusted trial balance, I said debit plus debits minus credit minus credits. And for me to get the balance on, the one for the credit side, I said credit plus credit minus debit minus debit.
Okay.
Do you understand? Then
yes,
after I completed that, then I remove all the negative values on the on the adjusted trial balance. And when I scroll down, you will notice that the two sides are equal. Are you with me?
Yes, we'll get that, sir. So my question is that in the next
period, in the first place? Azuka. Okay, go ahead.
Sir, in the next period now, are we going to continue with the former trial balance, or we will continue with this one because of the adjustment? Because normally we are supposed to affect the adjustments in the trial balance, and which we fail to recognize then. But now we've created another adjustment, ETB, as a new sheet now. So if we want to continue starting from the next period now, are we still focusing, or we used to use the former trial balance, or we will continue from this place? I don't know.
Okay, so I will answer that question in two different respects. I will answer it where it is the auditors that raise these adjusting entries. If it is the auditor that raised these adjusting entries, you'll notice that at the end of the audit, they will give you audit journals. You are expected to go and effect those audit journals in your own financial, your own software, such that your closing balance will now be the same with the auditor's closing balance. So in a nutshell, you will disregard the earlier trial balance figure, but what you will continue to use in the subsequent period is now the adjusted trial balance, because that is the balance that reflects your actual balance, right? But if it is not the auditors that raised this, but it is you or your boss that did that particular thing, or within the company, the trial balance you will be supplying the auditors with is not the first balance, but the adjusted trial balance. Does that answer your question?
Exactly, sir. Thank you, sir.
All right. Any other question before we continue? Do I assume that everybody actually understood what we have explained thus far? Khadijat, do you understand?
You
Khadija
said
has gone to watch football. Is Khadija there?
Yes.
Timothy, do you understand?
Now that's why I want to ask you this, brother.
Okay, go ahead.
Okay.
Khadija, let me see your face. Are you sure you're not watching football? I'm just joking. Go ahead. I mean, Timothy, go ahead. Go ahead.
Okay. After you had the debit side of the adjusted trial balance, you say debit plus debit on the debit side minus credit. Now you scroll down. Then my question now is, you say you remove every negative one out of it. Won't that affect the normal account?
It will not. Look at
Okay,
it.
what
I've done that
project
now.
will have a negative effect on the first instance?
No, what do you say?
What brings the negative effect on them as well? So I'll write to
Yeah,
know.
it is just our programming on Excel. You know, normally look at the role for right of use of assets. Can you see it?
Yes.
Are you looking at the screen? You know, see where my
Yes.
cursor is. I'm having debit 500.
Yes.
I'm having on the adjusting entries, I'm having credits 100.
Yes.
A layman who is not used to how Excel works, we just say this 500 minus this 400, and it is wrong. Do you understand?
Okay.
If you are working on that, if you are doing it that very way, it means one has a low level of understanding on the use of Excel. So the best way for you to go about it is to use that rule I've given to you. You will notice that when I did that now, I copy and paste it now. My debit side is showing 400 positive. My credit side is showing 400 negative. So I will just remove the negative.
Okay.
And I will do that across board.
Okay.
Do you understand? By the time I get to the total, because ordinarily, each line on the adjusted trial balance should have just one figure. And the one figure should only be the positive figure. So you can see now that if what I've done is wrong, the trial balance at the end of the day will not still balance.
Yes.
So this concept is usually common with auditors. Is Grace here? Grace, she has gone to do kitchen duties. So Grace is an auditor. She will have been able to confirm. Is there any other auditor in the house?
Yes, sir.
Yeah, who is that? Damilola?
Yes, sir.
I'm sure you are used to what we have just displayed.
Yeah, I understand it, but I think looking at your screen today, it's more wider than what I'm used to. But I could relate. Something I can relate to.
Sorry, I didn't get you very well. Make your points clearer.
I said I could relate to what you are doing regarding the formulas. Just that looking at the screen today, at least I get a wider exposure.
That's good. That's
the
good.
ETB
That's
was.
good.
It's something I'm familiar with.
Okay, that's good. So for those who are not in the audit space, this is one of the brouhaha that auditors use in their working tools, right? So the next column of the extended trial balance, we've seen the trial balance, we've seen the adjusting entries, we've seen the adjusted trial balance. Let's now see the next column, the income statement. Now the income statement.
Sir,
Yeah, go ahead.
I just want to make okay. It depends. Though for me, if I'm to use this adjusted column, instead of me removing the negative aspect, I think it depends on your level of knowledge on using Excel. I think if function we do the magic. So why
Of
apply if
course.
function? It
Of
will
course,
just it will not even show the negative at all.
Yeah, I agree. I agree. But you know, this class, there are people of different backgrounds there. So if you use those complex Excel tools, a lot of people will get confused. I agree. Even when you are bringing in all of these balances, I could have used VLOOKUP.
Yeah.
Do you understand?
Yes, sir.
Mm-hmm.
That's
I agree. All right. So so when you want to make transition to the income statement, you remember that the income statement will not contain any assets, liability, or capital. So you will notice that I'm scrolling down to where I will see income statement items, right? I'm scrolling down. So on this very one, we don't have any revenue, right? We don't have any other income, but we have expenses. So I will equate it. It's on the debit. I'm also putting it on the debit side. I will go down. I have professional fee. So I can, the only expenses I have, it's the right of use, the depreciative element of it, and the what? And the professional fee. So what you only do here is to make sure that you link the income side to the credit side and the expenses side to the expenses side. Then when you get to your trial balance, when you get to your balance sheets, you will then link the assets to the assets, liabilities to the liabilities. So let's see whether we have any balance of such. So you go through the adjusted trial balance. Let's see again. You can see on the asset side, I'm having 400. I've linked it to the balance sheet side. I'm going down again. I'm having inventory. I've linked it. I'm having bank one. I've linked it. Then I'm having ordinary share, 1 million for Abdul.
We did not bring out of this guy, Jordan.
To scroll down to see whether there are still some other items. Liabilities, I brought them in, then scroll down. The next one I have here is income statement items. This one will not come to play. So let's see what the total of this should be. Total of that, the debit and the credit should be equal. You will observe that they are not equal, right? Hello?
Yes, sir.
You will observe that they are not equal. The difference is 1.1, which is also the difference we have in the income statement. So it means in the income statement, since we only have expenses, they will have had retained loss in that year. By the time you bring the retained loss into the balance sheets, then the trial balance will be, the balance sheet will be fine. So this is what the simplified way of outrightly showing how extended trial balance work in a much more complex scenario. I wish this class was a physical class. We will have picked more practical scenarios and actually do the setup, do the linking, but with what we have done, I'm sure that if we try to lay your hands on some practical instances, you should be able to add read value. And for the benefit of those who have not taken up an accounting role before, I will advise that you revise this very well and chat your colleagues if you have any challenge. Try to practice scenarios, simulated scenarios for accounting function, so that by the time you go for an interview and they are asking you any of these questions, you'll be able to perform. Then you can also try to enroll for practical classes, maybe much more physical ones, to complement your understanding. This information is for those who want to switch career. Maybe they are in banks and they want to train themselves to be able to take up an accounting role, or you are an accountant, you have not had practical exposure enough. Please, this will help you. But in addition to this, you might still need some practical sections. At KCP, we can do that for consideration, but it doesn't mean you have to come to us. You can relate with any of your colleagues, but if you think you want to use us, you will have to pay for that practical section. This is what we are giving out for free. So that's what we need to know tonight. It's almost 8 o'clock and we need to strictly adhere to our timing. I hope what we have done today would have added real value to you. For those who have done this before, it will be a refresher. For those who have not done it before, I think it will be an eye-opener for areas you need to pay attention to. And you might also consider the need for enrolling for accounting software trainings, which could also increase your chance of employability or chance of getting much more better employment offer. Any other question? Any other question before we call it a day? We want to strictly adhere to schedule for each day's session. Any question? Any area of additions, clarifications, or additional comments?
Yes, I think there's a question, sir. Sorry, sir. This is Abdul Qadir Yahaya. Sorry that I came late, but I got everything. The only question I have here is that, sorry, trial balance. According to my own understanding, they say it is used to to check and correct errors from the ledger. Does it mean that when you use this trial balance to correct or to check the errors in ledger, after using this trial balance, does it mean that the account is correct absolutely?
Let me first of all correct the wrong notion. Trial balance is not used to correct errors, right? It gives its point. It is a pointer that there may be an error in your prior postings. So, and the only indicator is that you will see that the two sides of the trial balance may not be equal. But we don't use trial balance to correct errors. You use journals to correcting errors, right? So if we have identified an error now, you will have come to your journals here, raise the journal, the appropriate reclassifications, and link it to the ETB or link it to your what we call your regular ledgers, right? If you are using an automated software, it is presumably it's not expected for you to have made an error, but should you have made an error, the moment you raise journals, the system will automatically hit the right debit and the right credit account. But if you are using these partial automated ones, after you have raised the journal, then you then come to the ETB, relink the party that needs to be debited, relink the party that needs to be credited. Immediately you do that, you will see that your adjusted trial balance will then reflect the correct balance, right? But take it from here that you don't use trial balance to correcting errors. I hope that is clear.
All right, thank you, sir. I got you, sir. Thank you.
All right, so don't forget to mark your attendance. Attendance is very key, right? And don't forget to refresh, revise every materials we share not later than tomorrow, all the video sections for all the things we have done this week will have been available. The link for the download will be shared with you. Then for all the other materials that I promised to share, it will be made available alongside with those links. I've made available the IFRS for SMEs, the soft copy of it. This Excel template that we use for this section will make it available.
Wow.
The slides will be made available. Then I think that's all. The slides and this particular Excel sheet will be made available for you to practice.
Thank
All
you,
right,
sir.
so
Thank you very much.
in the absence of any other question, this is where we will draw the curtain. Please, this is just the second week out of the 12 weeks we want to use for this training session. I will encourage that you stay tuned throughout all the section, because we are assuming zero knowledge and we are building on this. So as we get into the later part of the week of this mentorship, the things we'll be discussing will be at a very higher level. So we might not be entertaining all these petty questions there, because we will have assumed that at the earlier part of the session, you will have acquired those fundamental skills. So please revise those standards, revise the laws. There's so much materials for you to read. Revise the standard, revise the laws. And should you have any areas of clarification, put the question forward. I'll be glad to be of assistance. All right, so enjoy the rest of the night, and I wish you a very pleasant working week ahead. See you next same time next week, Friday, Saturday, and Sunday.
Thank you.
Thank you, sir. Good night, sir.